Okay. Hi everyone, I'm Valentina Sanchez Cuenca at the Bird Traps Report. Welcome to another wonderful episode of our new series called The Turning. Today we're going to talk about credit indicators, the Fed meeting, and everything revolving that. Today we have two special guests, James Robinson and Robert Agans. You guys, what is happening today? Tell me about it.
Okay, thanks, Valentina. You know, our goal at the Bear Traps Report comes down to one thing: the democratization of information. And we run an institutional Bloomberg chat in about 23 countries with hedge funds and mutual funds, very professional investors. And what we're trying to do today, and our host James Robinson is going to kind of be the umpire, is we want to broaden out the message because a lot of things are happening this week around the Fed meeting, credit leading equities in a lot of different spots. And Rob Agans has been, I've known Rob for years. We were introduced, our friend at Moore Capital, one of the top hedge funds in New York, introduced me to Rob over a decade ago. Rob has some really important credit indicators. And Robert Van Battenberg, we call him the Dr. Ben Battenberg, is here again. And Rob's got incredible insights around the Fed meeting and what's really happening, a very convoluted message. But I think we'll kick it off with the first chart, Jose. And I'm going to talk about I'm going to kick this off with capitulation in the TLT. We did a bullish bond call about a week and a half ago. Dr. Van Battenberg wrote up this report around all the leading indicators around in terms of the Treasury market and the bullish divergence that we're seeing in terms of Treasuries. And so as you can see here at the bottom right-hand side of the screen, we had a capitulation climax. This is a category 4. Think about a category 4 or 5 hurricane. This is a colossal capitulation with that peak volume about a week ago. And then you can see that bull hammer formation on the bottom, I guess on the right side of the screen. And there's a number of things that are happening. It's not just technical analysis. There's major structural things that are happening in the Treasury market that we laid out to clients over about 10 days ago. But our capitulation model has 7 different factors. One is the RSI, which is that weekly positive divergence, and then we have some daily. These are really bullish signals in the Treasury market, and essentially we're getting a lot of rate of change of the economic data in the recent weeks, whether it be Whirlpool or all these different companies that are reporting earnings. Different credit rating agencies have been reporting a weakness in the consumer credit. And so, Rob, I think we'll kick it off with.
Go ahead.
I think we'll kick it off with you, Rob.
Okay, so yesterday we had a very paradoxical Fed meeting with Powell once again flip-flopping. It's the start of the speech, which came about half an hour after the Fed published their statement, which had very little change relative to the September statement. Powell came out and saying that the FOMC would go and be very cautious or very careful going forward. And the market, of course, interpreted that to be bullish in the sense that, no more rate hikes. Then 5 minutes later, he said, well, the Fed is not done yet. And the market, of course, rolled over hard, worried that the rest of the speech would become very hawkish. And so he went back and forth a few times talking about they were still not having a quote-unquote neutral bias, which means they wouldn't stop raising rates. But then he said something very interesting. He said that the dot plot, which is essentially a forecast of all Fed members where they think interest rates are going to be in the next couple of years, from September was very stale. Remember, they only come out with these dot plots every quarter. So what he was suggesting is that right now those dots may actually be lower. In other words, the Fed, the collective of all the open market committee members, may actually see rates a little bit lower than where they were in September. So the market gained a little bit more confidence out of that. But be quite frankly, we've seen how over and over flip-flopping, flaky, Remember, this is the guy who ripped up a speech in an hour or so before the Jackson Hole conference in 2022. So they're happy that once he stopped speaking, and that's when the market really started rallying. So what does it mean for us? Okay, so with a Powell, when you don't know what kind of Powell you're going to see whenever he starts speaking. So the market goes into these speeches, these meetings. Every time Powell speaks, they go into it rather cautiously because we don't know what kind of Powell we're going to get. And then what's very important for the market today is how long does the Fed stay at this level? Powell, of course, couldn't say that to us yesterday, but we have veterans like Bill Gross, like Gundlach, like Stanley Druckenmiller that are warning that a recession is around the corner if the Fed maintains its kind of level of interest rates. So the longer they stay at this level, the longer that Powell it remains ambiguous whether he wants to cut or not, the more the market starts pricing in, oh, we're going into a recession. We've already seen a lot of retail names getting clobbered. We saw Facebook warning about weakening conditions into October. So that's where we are. Larry.
Well, I would just say institutional clients in the chat, and James, I want to get your opinion on this, but what they've been talking about in September, there was a rate of change in the data. So something is altering the Fed's path. Like you said, the dots, we're forecasting a lot more future hikes. Those Fed dots have come down. And the rate of change, I think it comes down to one of the big things that people are alluding to in the chat, student loans. So in October, we have 40 million Americans that now have an extra $300 a month payment. 40 million Americans, $300 a month. And you're seeing this in a lot of consumer-facing companies. So there's a rate of change in the data where things took a lower, a leg down in terms of the economic data. That's, I think, scared the Fed. Now, the Fed's a little bit like a pilot on the airplane, right? They want to keep the fannies in the seats, but they are very disturbed at what's happening under the surface. That's why they're opening the door to not just cuts, but to stop now. But eventually, in the next couple of months, they're going to have to open up the door to rate cuts. Is that clear, James?
Yeah, that's very clear, Larry. But, I have a big question around the consumer strength because if you look at the last week, you have Amazon that came out with great earnings. Maybe people are just getting ready for Christmas. You have amazing earnings out of Starbucks today. Qualcomm killed it, which means that Apple did very well. And I heard reports that people are actually finally upgrading their iPhones, which they were stalled on. But, if you just look at the lifestyle of an American consumer, and look at the level of credit card debt, like they're not actually compromising on their lifestyles yet. They're still, do you agree with the phrase like never stand between an American consumer and the cash register?
Well, the problem is, Apple's at 7 times sales, right? And from 2010 to 2020, it averaged 2.5 to 3 times sales. So the consumer's always been a spender, for a long, long, long time. But, over the last 20 years, stocks like Apple have traded at 2 to 3 times sales, and now they're trading at 7 times sales. So the bar is extremely, extremely high for their earnings that I think come tonight. Rob, I want to get back to you on this dollar chart. So this is one of the things that Jens Nordvig, our friend, makes a big point around is rate of change in tertiary currencies. And in the chat, we have a conversation today. And if you look at the Korean won, if you look at other currencies around the world, they're strengthening versus the dollar because the Fed's opening the door to a softer path, right? And one of the things that the team at Exante and our Bear Traps team, we measure scientifically and meticulously the rate of change in movement of currencies versus the dollar. And the tertiary currencies are like the third and fourth tier, so smaller countries. And in the last week, there's been a pretty sharp move of the smaller countries against the dollar. And that speaks to a potential game-changing shift in the US dollar. Rob, your take here?
I want to comment on James' Okay, so this is the complexity of the U.S. economy, right? $26 trillion economy. Um, the the dynamics and the cross currents in this economy leads companies like Hasbro and Mattel and Dollar General and Target to collapse because of slower consumer spending. But at the same time, you get companies like Ferrari that are raising their guidance. You have companies like Amazon that are reporting really strong earnings and really strong guidance too. Shopify this morning, right? I mean, they're the backbone of e-commerce. They reported really robust earnings and guidance. So the complexity makes it so hard in this market. Where are we going? Are we too hot? Are we too cold? And this is what Powell is grappling with as well. But where Alan Greenspan was so good is that he would talk so much, but he wouldn't say anything, right? He would say as little as possible about the path forward because it's rife with uncertainty. But what Powell is doing is he's doing exactly the opposite. He thinks that the more he says, the more clarity he provides. But it's just confusing people. It's burying the market with ambiguity. It's like, where is he? What is he going to do? Is he going to raise rates or is he going to lower them? What is he thinking? And that level of uncertainty leads to these wild gyrations going into the Fed meetings. And it leads to these rallies coming out of the Fed meetings because people are just happy he's done talking. So with respects to the dollar and treasuries are very highly correlated, which means that whenever the treasuries bonds go down, the dollar goes down, the dollar goes up, and the other way around. So we saw already a couple of days ago when treasury yields, when the interest rates on treasuries were still going up and everybody was talking about it, it was like going to 5%, the dollar was weakening already. And Larry and I pointed out, well, look, this is an ominous time because the dollar is telling you that treasury yields may actually start to roll over. And now we're in the midst of that. And that opens a path for a yet weaker dollar, which leads to more strength in other currencies, and especially emerging markets are extremely sensitive to that because
So
they
Rob,
are.
where's the trade? So EMLC, the Emerging Market Local Currency Bond Fund, in calls this week and last week with institutional investors in London, I spoke with one of the sharpest famous macro investors in the world, and his team in the last month has been buying emerging market local currency bonds. And the way to express that for people watching us right now is the EMLC trading just above COVID levels. But in points of time when the Fed is stopping a hiking cycle, there are different trades that really work, right? And so as you can see here with the dollar chart, if the Fed is really done, this is a point, as you can see those circles in the past, those are shifts in Fed policy, right? So if the Fed is really opening the door to a softer path, and it's like you said, as Gunlack and as Bill Gross are alluding to, and it's Stan Druckenmiller, I mean, the big three, these are three Hall of Famers now, right? They're all saying the same thing. So the Fed has a slightly softer path. One or two good ideas is in the emerging market space, the EMLC, Emerging Market Local Currency Bond Fund. I want to bring in Rob Agans now because, like I said, Rob's one of the best credit minds I know in the corporate bond market. On Twitter, my handle's at ConvertBond, and Rob's at Corp Trader. And Jose can bring in the next slide on triple C's. But Rob, I noticed today triple C's are blowing out. Like, what's going on? Like, the spread on triple C's is blowing out today. Walk us through the connection between the Fed, Treasuries, and triple C's, and what's that telling you about the road ahead.
Yeah, I think one of the important themes, when we talk about a yield curve inversion, we talk about it forewarning a recession. But when you see that yield curve really start to steepen, that signals the imminence of that recession. And I think what is going to be a major theme, and that's not necessarily like today's trade, but it's an intermediate term trade for sure, is going to be a shifting narrative from what has been the major kind of risk to the market of the last 6 months to a year in rising interest rates, but certainly in the last 3 months with rising long-term interest rates, that interest rate sort of volatility that's been in the market is going to transfer, in our view, to credit volatility. And we think that's kind of what you're seeing here with the triple C's. I'm also seeing that in investment grade, where you've got, today the investment grade market's rallying, pretty hard. But there's quite a bit of credit dispersion where you've got, higher beta, higher risk, triple B corporate bonds that are in companies producing earnings reports that are, followed by like an 18% drawdown in their stock price. Names like Estee Lauder, FMC, and others, their bonds are not rallying in sympathy. So you're starting to see that dispersion where active managers of corporate bond portfolios are, sort of getting paid to be in the right credits and out of the ones that are, not looking so good. And we've got a proprietary multi-factor credit model that we built probably 6-7 years in the making, which scores the entire universe of investment grade, high yield, and distressed debt. And the the signals that we're picking up have been high.
So let's get into credit leading equities. So one of the things about your model and our model is that you could see over the last, like you talked about that dispersion, over the last 6-7 weeks, the rate of change in the data, like TransUnion, Equifax, companies that run credit checks for consumers, the stocks are down like 50-60%. And these are companies that run credit checks for consumers. Whirlpool, Macy's, Nordstrom's, like every company that's facing the consumer just about has shown a tremendous amount of weakness. And one of the things that you pointed out in the chat maybe 6 weeks ago, credit leading equities, where you saw these bonds of these companies in the consumer space, especially triple C's, a lot of them started to underperform relative to the rest of the market. Is that what you're trying to get at with dispersion?
Yeah. Also, it's just an interesting backdrop where you've got, when I look at my credit model, the main thing that it's telling me is long energy, short consumers. So when you think about the backdrop of going back to your DXY chart, if the dollar starts to sort of reverse here, give back some of that strength because of the Fed out of the picture, you've got a potential issue where oil prices can catch that bid on the back of a weak dollar and war, and these credits are already scoring high. You've got CapEx cuts coming from the likes of Shell today.
Capital expenditures.
Yeah, they're cutting capital expenditures, so that's less oil in the future, and they're returning more cash to shareholders through buybacks. So, but Shell is a high-scoring credit in our model, and we do factor in, share repurchase programs, but we don't see them doing an aggressive program. It's well within their capacity to return, their excess profits to their shareholders, and it's not really at the expense of bondholders. We would score that in if it were, but it's just kind of a telling in that environment, which looks increasingly stagflationary. That I'm picking up signals of weak consumers and strong energy prices, which only kind of is a negative feedback loop, if you will.
So I want to bring James in. So Rob, explain very briefly, Rob Agans. Credit spreads were tightening, the last, if you can see there on the chart, they tightened from say March to June. A lot of that people don't understand really has to do with treasuries. So as treasuries ripped higher in yield, there was kind of like a distortion in the market where it appeared that credit was in a really good spot. As you can see there, that's lower credit spreads. You see that? That's typically means healthy. But today we've got this violent move wider in triple C's. What is that telling you, like relative to treasuries? What's causing this?
I think the main issue with, and we spoke about this earlier when we talked about the transfer of risk from interest rates to credit. The thing that what really happened with corporate credit, from not just triple C's, but from investment grade, high yield, and all the way down, is you had a de-risking of the asset class through the move in interest rates. So, for example, if you had a par, triple B, 30-year, high beta, long duration corporate bond that was priced at par a year ago.
Long duration, you mean long term, like more than
long term,
15 years.
A 30-year corporate bond that was priced at par, or issuing bonds at par a year ago. Those bonds could be 60 cents of the dollar now with the move in interest rates. And because of that de-risking in the price, when you take the bond from a par price from 100 to 60, the credit spread really didn't need to do a whole lot to de-risk that bond, meaning credit spreads didn't need to widen because the interest rate market de-risked those bonds, for that.
Pushed them lower in price. The bonds were pushed
lower price from
lower
100
in price by interest rates going up, bond prices going down.
Right, and when the bond price goes down to that kind of level, the duration of the bond, riskiness of the bond, actually decreases pretty substantially. So the risk here that's probably underappreciated is that when interest rates stabilize, and maybe they've topped out here, we'll see. But when interest rates stabilize and start to narrow, that corporate bond that we just talked about getting de-risked starts getting risked higher again. The duration of the bond rises. So in order to keep that bond risk at unchanged levels, the credit spread has to widen. And when you see credit spreads widen for the highest quality companies, A-rated, AA-rated credits, you're also going to see that obviously happening out the curve, to higher beta corporate credit risks, but that ultimately funnels into the economy down to the consumer level.
So James, one of the things we talk about in our book, and James, you did a beautiful job structuring the book, writing. Your family has been an incredible asset to me. We wrote together Colossal Failure of Common Sense, which is now published in 12 languages. But in When Markets Speak, we talk about credit leading equities. For James, for the average investor, middle class, upper middle class investor, you're a dentist in Ohio. What is this chart telling you, and what is this conversation telling you, James?
Well, for me, I mean, this actually took me a few years to understand. But when, what Robert was just talking about was when credits blow up, and that basically means that a corporation, it gets more expensive to borrow money at that point. And you have to use your cash to service your debt. And that's why it hits your equity and it affects the stock, because the stock is your cash, right? So when you buy equity in a company, you buy a stock, that's the cash. So if more of that cash is being used to service your debt, obviously your stock is going to get hit. And is that why it hits the broader economy and then eventually the consumer? Because in order to shore up their cash, they have to raise their product prices. Is that in a really basic kind of nutshell? Is that how it works?
Yeah,
Okay.
And what I've seen over the years, and we talked about this in When Markets Speak, is that when credit kind of sharply widens, as you can see the chart here, right? It's the rate of change of credit that typically means there's near-term problems for equities. If credit is widening slowly at 10 miles an hour, not a big deal. But one of the things we talk about in When Markets Speak, and the book will be out in the first quarter, is if the rate of change in credit spread widening, it goes to 90 miles an hour. As you can see, right before the banks blew up, credit was starting to really move pretty fast. And I'm pretty disturbed because, stocks are up today on relief, as Robert alluded to. They're up on, okay, the Fed's done. That's great. But as Dr. Robert Van Battenberg was alluding to, but as Rob Agans gets into here, is like the rate of change of credit spread widening tells you that there's something underneath the surface that we need to look out for. To me, this chart tells you to get long equity vol. So let's say either VIX or any one of there's a lot of different products in that area to get long. This chart's telling me that equity vol today is probably cheap relative to the big move higher in stock prices. But I think that's a great segment. Valentina, I want to kick it off to you. Valentina?
Valentina's on mute, so maybe she could find a way to release that button.
Okay.
Thank you so much for joining us today, and thank you so much, Rob and James, for being with us today. Everybody, if you want a free trial to the Bird Shops Report, I can give you 21 days. You just have to reach me out at valentina@thebirdshopsreport.com. That's valentina@thebirdshopsreport.com. Also, we have our upcoming mood coming out in Q1 2024, and you can pre-order it now on the link you can find below. Thank you so much.
Great to see everybody. Have a wonderful weekend. We'll see you at the top. Thanks. God bless.
Thank you, Larry. Thanks, Robert. Valentina.